18. Building the internal M&A team, roles and structure. Why companies need internal M&A teams. M&A transactions require coordinated effort across multiple functions within the acquiring or selling organization. Companies cannot outsource all M&A work to external advisors because internal teams possess irreplaceable knowledge about company strategy, operations, culture, and capabilities. Internal teams maintain strategic control, ensuring external advisor recommendations align with long-term corporate objectives. The internal team coordinates all transaction work streams, manages external advisors, and makes final decisions on critical issues. Without dedicated internal resources, deals lack strategic coherence and execution suffers from poor coordination. External advisors bring specialized expertise in valuation, legal structuring, and regulatory compliance. However, they cannot replicate internal understanding of strategic fit, operational integration requirements, or cultural compatibility. The most effective M&A execution combines internal strategic leadership with external specialized expertise. When to form the internal team. Companies should establish M&A teams before approaching targets or advisors, not after deal opportunities emerge. Early team formation allows proper resource allocation, establishes clear decision-making authority, and identifies capability gaps requiring external support. Reactive team formation after deals surface creates coordination problems, rushed decision-making, and missed strategic considerations. For companies pursuing multiple acquisitions annually, permanent corporate development functions provide ongoing M&A capability. For companies making occasional acquisitions, temporary task forces assemble for specific transactions, then disband after integration completes. The team formation timing depends on transaction complexity and organizational M&A experience. Core team composition. Corporate development leadership. Corporate development leads overall deal execution, serving as primary coordinator across all work streams. The corporate development director reports to the CFO or CEO, depending on organizational structure and deal materiality. Responsibilities include deal sourcing and screening, coordinating due diligence work streams, managing external advisors, negotiating transaction terms, and overseeing integration planning. This role requires both strategic thinking and operational execution capabilities. Chief Financial Officer and Finance Team. The CFO provides financial leadership throughout the transaction, serving as key decision-maker on valuation and structure. Finance team responsibilities include financial modeling and valuation analysis, quality of earnings assessment, financing arrangement, tax structure optimization, and purchase price allocation. The finance team works closely with external accounting firms conducting financial due diligence. They translate financial analysis into actionable recommendations for senior management. General counsel and legal team. The general counsel oversees all legal aspects of the transaction, ensuring regulatory compliance and risk mitigation. Legal team responsibilities include legal due diligence coordination, purchase agreement negotiation and drafting, regulatory filing preparation, and intellectual property verification. The legal team manages external law firms handling specialized regulatory or jurisdictional issues. They balance deal momentum against legal risk management. Business unit head. The relevant business unit head provides operational expertise and integration leadership. This executive understands target business model, assesses strategic fit, validates commercial assumptions, and leads post-merger integration execution. Business unit involvement ensures deal rationale reflects operational reality, not just financial projections. Without business unit buy-in, integration execution typically fails. Extended team roles. Human resources. HR addresses workforce integration, including organizational structure design, compensation harmonization, cultural assessment and integration, key employee retention planning, and change management communication. HR involvement begins during due diligence, assessing cultural fit and retention risks. Information technology. IT evaluates technology systems compatibility, data migration requirements, cybersecurity risks, and systems integration timeline and costs. IT assessment during due diligence prevents post-close integration surprises. Operations. Operations assesses supply chain integration, facility consolidation opportunities, process standardization, and operational synergy capture. Operations validates whether projected synergies are operationally feasible. Tax. Tax specialists optimize transaction structure, evaluate tax liability assumptions, and plan post-close tax positioning. Tax input shapes deal structure decisions between stock and asset purchases. Organizational structure and decision authority. Establishing clear hierarchy. Successful M&A execution requires unambiguous decision-making authority and escalation paths. The deal sponsor, typically a C-suite executive, serves as ultimate decision-maker with board approval for material decisions. The corporate development lead coordinates daily execution reporting to the deal sponsor. Functional leads for finance, legal, HR, and operations report to corporate development on transaction matters while maintaining reporting relationships to functional executives. This dual reporting structure requires clear communication protocols. Weekly steering committee meetings. Core team members meet weekly to review progress, resolve issues, and make tactical decisions. Meeting agenda covers due diligence findings, valuation updates, negotiation strategy, integration planning, and external advisor coordination. Clear meeting cadence prevents coordination failures and ensures timely issue resolution.